Okay. I was told I should have 5 minutes before we get started after 9 o'clock, and I should complete my lecture 5 minutes before the end time. So my name is Zhong Yan, the capital Z. This one should be, okay, that's my last name, ZHU. Here is my email address, first name dot last name @monash.edu. Just a brief introduction because I just finished my contract in Hong Kong and then I moved here. Because of the different systems, I cannot start in the beginning of this semester. Last week, Wednesday was the first day in Monash. So I teach this week on Tuesday and Friday, and I will keep one for a few weeks. My co-instructor is Hannah. Just a brief introduction of myself. Original coming from mainland China, working for the Central Bank of People's Bank of China for a few years. Then I got my master's degree in UK, England. And then I find myself a job in London City. But I like to do research very much. So I told the corporation that I want to research. I say the master's degree is not necessary. It's not a necessary condition for doing research. So I asked them, what's the necessary condition for starting doing research job? They say, you have to do a PhD. After struggling for a couple of months, I made my decision, apply for a PhD. So I quit my job in London, prepared the PhD, and then got enrolled at Indiana University of Birmingham in the United States. After 5 years, I got my PhD degree, found 3 job offers, and I accepted the job offer from Hong Kong. The other 2 was in the United States. Spent a few years in Hong Kong and try to get a better living environment, not so crowded. So that's why I started looking for the job in the English-speaking countries, also called Anglo-Saxon. And then Morgan gave me an offer. That's why I'm here. So today we're going to, this semester we're talking about the corporate finance theory. And in this lecture, to my understanding, is we need to start with the tutorial solution for the T-1 week. And then I'm going to upload the solution result after I finish everyone's tutorial on Friday in the afternoon. That's what my understanding is. During the whole lecture and tutorial series, feel free to raise your hand if you have any questions. I'm happy to address them if it is very short. It's a relatively involved, longer discussion. You can feel free to stop after the lecture. My consultation hour, 1 hour consultation, would follow the lecture after Tuesday and Friday. So that's exactly my consultation hour. So it could be anywhere during the whole way, or if there is no follow-up class in this classroom, we can still discuss it here. Any other questions could send me forward by the email showed above. Okay? Any questions so far? If no, then let's get started. So we have a few questions here. The first large question, including sub-questions from the chapter book of chapter 10, which is coming here. I assume everybody has already have a copy. Then the second one would be another one, which is extended from the textbook chapter books. Okay, so let's directly go to Is that big enough for everybody to see even in the back? Yes, please. Oh, okay, how to turn the lights. Right now we are in lecture. Should I change to the movie? No, the lighting selection is, let me change to the movie to see. lecture, movie, menu, lecture, no, lecture like off. So, anybody know how to change this one? Or is there someone I can switch off the? It's air conditioner. Is that good? Or too dark? Okay, too dark. Okay, maybe. Oh, that's better. Okay, okay. So, pardon me because it's the first time. This is really the first time I've been in this lecture. Okay. Yes. Zooming in a little bit more, or out. In. 150. 200. Big enough. Everybody. Yeah, I want to make everybody comfortable. Is this good enough? Big enough? Okay. Okay, so the first question is 1023, internal rate of return. Calculate IRR for the following project with 3 different cash flows. The first sub-question, question sub A, initial outlay of $3,125,000, followed by annual cash flow 565,325 for the next 8 years. And the second is initial investment 33,750, followed by annual cash flow 9,430 for the next 5 years. And third one is initial outlay of 10,000, followed by annual cash flow of 2,500 for the next 7 years. So in general, these 3 sub-questions are relatively the same. There are only the major thing here is the difference between what's the initial quantitative initial investment, and then what's the difference of a cash flow annual, and then is how long the project lasts. So we'll put on the solution for. We'll put the solution for 3, and we'll try to explain the sub-question 1 in a little bit of detail, and then the rest of them could follow the same manual. One thing we have to think about is since we calculate the net present value, and we need to lay out the cash flows. And when we lay out the cash flows, the number is very easy to get. But the important thing for you to think about this is whether the direction of the cash flow is inflow or outflow. So how do we deal with the questions like this? Is you're always thinking about from the perspective of an investor or the investor for the projects. For example, let's go over to the 3 questions here. Is as an investor or from the perspective of the investor, you are going to put the cash out of your pockets to invest on a project. So from your perspective, this is a cash outflow. So when they say there is outlay, there is an investment, they relatively refer to the same thing. Take the cash out of pockets and invest on a project. That's a cash outflow from your perspective. Okay. And the next thing is cash flow in the next few years. And there are 2 scenarios, whether the cash flow in the next few years could be either inflow or outflow. Okay, I'm going to give you specific examples later on when we deal with the rest of the questions in today's tutorial. And let's take the first 3 sub-questions A, B, C here, for example. The understanding of those annual cash flow should be from a perspective as an investor, you invest on a project, and this project is going to bring you cash inflow in the next few years. So that's how we understand in this one. So why I want to specify this direction very much, because in the second largest question, which is question number 2, you're going to find out that cash inflow and outflow could be project dependent. And in that case, normally we're talking about corporate finance positive NPV project that we should accept. What if the 2 projects all give you negative NPV project? And you may wonder what kind of project it is. Should we accept or should we reject them all, or should we accept just one of them? Then we're talking about we could and we should accept one of them, even if the NPV is negative, but based on what? Based on the difference of cash inflow and outflow. So that's the reason I want to put very upfront to talk about the direction, and then mathematically we're talking about a positive or negative sign associated with each cash flow. So to get more flavor on this, initial investment, there is no sign here. Annual cash flow, no sign here. Length of the project, 8 years. And then when we put it into the NPV formula, then here is the sign that we're talking about. Initial investment or outlay, $3,125,000. That's a cash outflow from the perspective of the investor. So it has a negative sign in front of it. And for the next 8 years, each year, this project that the investor has invested at t equal to 0 year is going to bring up more cash inflow to the investor with $565,000 and $325 each year. So that's why we have a positive here. That's the only thing I want to emphasize. I believe the rest of the calculation that you are quite familiar with. And then if we equal, the second element here is, if we equal the net present value equal to 0, then we can generate what is the IRR, internal rate of return. And in this case, we solve this 8%. Okay? And then how to solve exactly? Well, you can use the financial calculator, you can use the spreadsheet, use the goal seeker, or use a spreadsheet NPV function. But then this is another element we want to address, because if you put everything here in the spreadsheet, if you can program in the spreadsheet, or if you use NPV function in the spreadsheet, this is what the formula is going to give you. But what we are talking about here, which is the value why the students should set into the classroom, is sometimes there are many things here we try to emphasize more about the logic, the idea, the philosophy after each solutions. So solutions you can download, but the philosophies and ideas and the big ideas is going to be presented in the lecture theater room. Okay, here's what we're going to do. So all the financial calculator, the spreadsheets, and NPV function in the Excel follow the same logic. It's a try and miss logic. They don't even know what is the NPV is. They don't even know what is the IRR is. So for the machine, they just randomly generate a number, which is equal to IRR. So guess whatever the IRR is. Suppose you guess it's 8%. You plug the 8% in the formula, which is originally this is IRR. You plug into 8% here. This is Let me try again. Okay, it didn't work. Okay, so I don't do that. This is the IRR. You see the mouse cursor here. And you plug in 8%, and then you calculate the NPV. And you find out NPV is a positive number. 124, it doesn't really matter. What matters here is the NPV turned out to be a positive number. So what kind of information you can receive or you are going to interpret it with the 8% of IRR? It's what? It's
lower than the actual rate of return.
okay. So we're not talking about, so what I'm talking about is the logic here. Okay. Think about this. Initial investment is a negative number. Rest 8-year cash flow discounted by IRR and sum them up is positive number because inflow, initial investment outflow. And we have learned in NPV equal to 0 refer to the, because the initial investment is fixed, should not discounted by any interest rate or IRR. So this is a constant number here. What is going to change is in the second element, cash inflows. Cash inflow at this moment is not going to change. What is going to change or could be changed? It's in the denominator. It's the IRR could be changed. Okay, so you say here's the logic here. You discount the bunch of the cash flow in the next 80 years, sum them up, which is a positive number, and you try to use that number to offsetting the initial investment. And you get a positive number. In summary, what does that mean? Why the IRR should be higher? Give me the logic. Because a constant number discounted by in the numerator is too small, then the discounted cash flow would be much higher. Is that right? So because the discounted cash flow is much higher, so after offsetting the initial investment, then you have an NPV with a positive number here. So what are you going to adjust the NPV, adjust the IRR such that the NPV could be equal to 0? You need to crank up the number in the denominator. You'll make the denominator larger such that the discounted cash flow could become smaller. Okay, so that's what we discussed. This is how we think, and this is how the program writing in the financial calculator, in the spreadsheet, and in the NPV function. It's exactly the same thing. So we try a higher NPV, 9%. Then we find what? We find it's still a positive number. However, we notice that 4,248 is much, much smaller than the 124,000, which means we are on the right track. But the magnitude of IRR in terms of IRR increase is not enough. So we should do what? We should try an even higher NPV. So anything higher than 9%, you should try. Then you find what? In the real calculator or program, is you need to plug in a number such that the NPV could generate a negative number. So you need what is the boundary. You know where is the boundary. So this kind of IRR give you a positive number, and this kind of IRR give you a negative number. So what you're going to do is going to choose the IRR such that the NPV is equal to exactly 0. So that's the logic, that's a program. So we find out that eventually 9.034, that's a correct IRR. That makes our NPV equal to 0. That's the logic. Okay, I spent quite a few minutes on this one, and then the next one would just mechanical. You punch some, remember, punch the buttons with a financial calculator. There is a method 1, and there is a method 2. Then we can get the correct answer. Yes?
If I put a final answer 9.034 to the NPV function, you can find the NPV is 21.5. Is this right to accept this error?
Yeah, it's called a round error in this case. So when you calculate, when the machine delivered that NPV, they actually have more decimal place, but they only showed like a.
But in this case, the NPV is not the 0, it's 21. Is set.
Yeah, you can see that the 21 is much, much smaller than the 4,000 in this case. So I mean, what you have done is called a reverse engineering to double check whether the IRR is correct. But what the machine delivers to you is actually the calculate is 9.03 and maybe 3 to 4. It's a very shadow difference over there. So that's okay. That's okay. And any more questions? You do not necessarily take the photo because we're going to upload this solution to the web in today's afternoon. Yes?
In the exam itself, should we just do the numbers or we have to spend trying to figure out assuming IRR this rate and this rate?
No. So this is this is related to how we design the questions. If we design the question, try to test the students' understanding of this kind of philosophy, then we're going to ask a specific philosophy-related question. So we'll ask you, show the 3 trials you may want to design in able to achieve the IRR. So in that case, number does not really matter. You need to show me the design here. But if it's just to test you whether you can use the calculator, then we'll forget about all the philosophy. We just need the final results.
There will be a clear instruction about that.
There will be clear instruction about that. Yes. Any more questions? Yes. Yes, that's our assumption. That's our assumption. So let's try to, when we don't know what the IRR is, but we still put the NPV equal to 0, why we want to do that? Because that's the gauge. That's the benchmark to show whether your assumption or speculation is correct or not. If you have a magic number, you say 9.033, you put it into that formula, and then the magic NPV comes equal to 0. Then you get it right in the first time. So in this case, you can try NPV equal to 2. It's okay. If the NPV is equal to 2, the number will be much positive, much larger, and much positive. It's the same positive, much larger. Right side, this side? You mean the right side is equal to 0 or not? Oh, this is how we want to do that because everything, okay, so there is another theory here that I'm going to teach in next semester, next week. It's called the risk management. So we want to find the NPV project is at least equal to 0. That's the threshold we want to move in. So you see this. This philosophy only applies to the investment project that you invest upfront, then you get cash inflow for the next few years. Only for this. This one only applies to this. As you can see here, is as an investor, what's your cut-off decision to make to decide whether a project you should invest or not? Is the cash inflow this project is going to bring to you in the next few years would be at least as high as the present value of the investment you have to take out of your pockets at t equal to 0. So that's the philosophy why we want to put NPV is equal to 0. Right. Yeah.
Under this circumstance, you already know the value of the IRR.
No, they calculate the value of IRR. You don't know that yet. When you do that, let's see this one. In the very first place, you don't really know the IRR here. This one. That's always information we got based on the equation. IRR, we don't know yet. We calculate the IRR. This is why we need the IRR to compare the cost of capital, which I'm going to discuss today. And I think you bring up some good questions that is going to lead me to motivate today's questions. Yeah, this is going to help us to decide whether I should invest in this project. So IRR here is not enough because I have to compare the IRR with my own cost of capital. As an entrepreneur, I don't have all the money. If I need money, I need to borrow from the market. And the cost of capital is the cost I have to borrow the money from the market. I borrow from the market, I invest in a project, and if the IRR invested project return is lower than the cost for myself to borrow the money in the market, do you think I should invest in this one? You see, it's very intuitive. It's very intuitive in this case. So finance, as financial economics, is very intuitive. So now, right now, the difference between IRR and the cost of capital, that's a major threshold here. Okay? Good questions. We spent a few more minutes in the beginning, so go to a little bit of detail. I appreciate all the discussion. And then we can skip the rest of sub-question 2 and 3 because they follow the same philosophy and methodology. Any more questions here? Then we can move on. If no, we can move on. Okay. So BC, I just skipped them. Let's see the second one. I know it's 160, so let me zoom in to get a bird's view on this. The second question is 16.6, 14.8. Cash flow. What if discount rate was? Okay. So the second question here, 160. Okay. So the second question just to follow the same philosophy and methodology as we did in the first one, but the only thing that we try to let the students to appreciate different kinds of cash flow is when you invest it, then you find out the project that may not bring up cash inflow to the investor in any years. In this case, in the project 1, there's a zero cash inflow in year 1. In project 2, there's a zero cash flow in first 2 years. However, just because of the different cash flow does not necessarily mean that we should change our calculation methodology anyway. So we're going to use the same thing here. I just try to okay, so there is a third element here. There's a new addition element here. Okay, so you're facing 3 different projects. You're facing 3 different projects. So let's forget about the cost of capital at this moment. We only compare 3 possible projects. And then the first you have to make decision is which project you need to drop. So we're not a select in this one. We drop the worst one. We're not select the best one. We drop the worst one. What is the worst one here? Suppose that discount rate, when we use the discount rate here, then later on we understand, suppose this is your cost of capital. Okay? If this is a cost of capital 14.8%, then you discount by 14.8%, then you get a first NPV is negative number, and the second and third, second is a positive and third are negative. So in this case, negative NPV, which means the cash flow in the future is not enough to offsetting their initial investment. In this case, both first and the third project should be dropped. And you keep only the second one. However, if your cost of capital could be changed, and in this case is lower than 14.8, or there is another company whose cost of capital could be lower than the cost of capital of this company, which has 14.8, then the situation could change. And if, again, this is the if for the cost of capital or discount rate is 13.6, then the NPV of 3 projects change dramatically. The first one is still negative. Both the second and the third one turn out to be positive. So in this case, project 2 and 3 could both be the candidate of acceptance in your manual when you make the decision. Of course, in the real world, you usually choose to have the project with the highest NPV number. But that's not we want to specify at this moment. At this moment, only make yourself comfortable with IRR and NPV and discount rate. So that's the purpose for the second projects. Second question. Okay. A third question, 10.28. Project 1. Project 2. Okay, so the third project is bring up the flavor of one company is facing 2 mutually exclusive projects. So which means the company only has the necessary funding for any one project, but not both. So this is a very important condition. Company has only necessary funds for just the one project, but not both. Then we need to consider, in this case, we need to consider, first of all, is which projects is going to bring up a positive or negative number depending on my cost of capital, say. Okay? So what we're going to do here is we could do several methods. Is we just use myself's cost of capital, put it into the cash flow, and try to calculate the NPV, and choose the NPV with a higher number. Okay? The other thing is we can discount the project with a 0 NPV and get the cost of internal rate of return, and then compare the internal rate of return with my own cost of capital. And then we're going to choose the project with the IRR. Okay, this is the multiple choice question. Okay? So in the second method, think about this. 2 projects. Cash flow are given. Cash flow are givens. And the cost of capital is known, is also given. You know that cost of capital. Cash flow of both projects are given. Right now, you calculate project A internal rate of return based on 0 NPV is higher than your cost of capital. And the project B is going to deliver the IRR, which is lower than their cost of capital. Tell me, it's natural, it's very intuitive. Which one you're going to choose? A, why? I want to know why. Because right now, I only give you 2 choices. You always have a 50% to get it right, okay? Tell me the reason. That's the most important. And even if you give the reason, you give the wrong answer, and we know how to solve that. Tell me why. Yes, this is the story that I have already discussed. I, as an entrepreneur, I don't have all the money. I need to go to the market to borrow the money to invest. Okay? Then the market is going to assign different interest rate for different entrepreneurs. So my cost of capital is the cost that I have to bear to borrow the capital from the market in order to I go ahead with all the investments. That's the threshold money I have to pay. If a project is going to deliver an internal rate of return lower than the cost of capital, how am I supposed to make a profit from this investment? So that's why I should drop this investment immediately. If I have two projects, both give me the internal rate of return higher than my cost of capital, which one I should choose?
The bigger one.
The higher one, right? Why is that? Because the internal rate of return, which is, say, 5.3%, then my cost of capital for project A and the project B only give me 0.5% higher than my cost of capital, then the difference here is the project A could bring me 3% more rate of return in the next N years. So I should, as a rational entrepreneur, I should pursue the project that brings me with more money. That's the utility function. Okay, so that's the point here. So that's how I think this question is going to let the students to appreciate this flavor. Is internal rate of return and compare the internal rate of return with your own cost of capital and why you should accept the project and why you should reject the projects. Okay, so this is 1028. So all the calculation, I believe you have. You're very good at this one, so I'm not pursuing that direction. Okay, let me see. Let me see this one. It's catering. Oh, okay. So this one caused some discussion, stir up some discussion in my Tuesday's lecture. Okay, so let me tell you there is a discounted, okay, let me tell you this way, is when I move to here, the cash flow, that's the first one students may have questions, why we come up with the cash flow of 1,400,000. Is that the questions that among some of you at least? You're quite okay with this one? No, okay, so this is what we are going to discuss in today's lecture, okay? There is a depreciation and amortization. We need to first subtract it from the operation profit, and that's for calculating tax shield, the benefit of tax shield. Then after we finish the calculation of tax shield, then we need add depreciation and amortization back to the operation cash flow, and that's going to bring up the real flavor of so-called free cash flow when we make the decision in the capital budgeting. That's the main elements we are going to discuss in today's lecture, but at this moment, I just want to let you know that 1,400,000 is the summation of the after-tax net income plus the depreciation and amortization if there is any. Okay, summary. Okay, suppose right now I'm going to try to sort out the problem on this, the questions on this. I put this on hold. If you don't have a good understanding of it here, no problem at all. Give me the next 2 hours. I'm going to give you a full opportunity to explain this to you. Let's say this is the cash flow. Let's accept this one. Next one is, how do we calculate payback period? How do we calculate discounted payback period? Okay, so the difference between, when you look at this formula here, so we have the cumulative CF, cash flow. We have present value of CF. We have the cumulative present value of CF. So what does that mean? Okay, this is project cash flow here. The cumulative CF, which means we know that in the parentheses is a negative number. The cumulative will just add up what the number we have in the next year, right? So if I add up this number, sorry, cumulative, yes. Then we have, we subtract. So when we add this is a negative number. When we add this positive number, then it still be another positive, negative number. So this is how we add up. 1,400,000 to the negative 3,250,000. Then we get 1,850,000. That's how we add up. That's called cumulative, right? So what is the present value of CF? That is, the project here is going to give you this amount of cash flow and tell me what is the 1.4 million cash flow in year one, its present value. That's pretty straightforward, right? You discount by the cost of capital. Then you can get this number. For 1 year, for 2 year, for 3 year, for 5 year. You got this present value of cash flow. And in the last column, we follow the similar idea as cumulative cash flow here. We use the project cash flow minus, not minus, it's a plus, always a plus, because originally it's a negative number. We plus the present value of CF, then we got the cumulative present value of cash flow. Right? Okay. So what's the difference between the two? The difference is when you're calculating the payback period, you do not consider the present value of, let's say, for example, if we use the payback, the cumulative cash flow, is in year 2, we're still in negative number. But in year 3, we are in positive number, which means in the end of year 3, if we use payback method, the method already told you that you have fully paid it back. But we know we're in capitalism. $1 yesterday is not necessarily equal to $1 today because time value of money. Therefore, we should compare all these on the basis of present value or future value, whatever you want to choose. But right now, we use the present value. Therefore, in this way, once you use $1 today, is only equal to $1 today. It cannot be equal to $1 tomorrow, cannot be equal to $1 yesterday. And if we calculate it by this method, we find out in year 3, even if the payback becomes positive number, you actually is still owning your own investment. It's still negative number, and you need to get 1 more year in order to fully pay back. So that's the major difference of payback and discounted payback. And in the real world, we normally use the discounted payback. Okay? Rest of the calculation, I just leave that information about how we treated amortization and the tax shield in today's lecture. And then we move on.
What's the annual depreciation expense?
Yes, that's exactly what we're going to talk about in today's lecture, in the next lecture, when we finish this. Okay. Big questions, yes. Yes. Should answer.
It's normally in this, we talk about the income, right? We talk about income issues. To remind with this issue.
Say it again.
Because when we talk about the accounting rate of return, we take the income divided by the average of book value.
Okay.
And then we talk about income, we talk about everything already. Depreciation also we have to minus it out.
My short answer to that one is 2 points. First of all, we borrow some of the notation from income, but we are doing the capital budgeting. We're not exactly, because there are many other decisions we have to make. So we're not exactly follow that accounting. And the second one is a treatment of depreciation and amortization would be, as I said, would be detailed discussed in today's lecture. This is a capital budgeting. It's different from accounting at this moment. Okay, C and D is just the same calculation. Cost of investment, 4 million, annual, discount rate 12, cash flow, calculate the payback, discount payback period, NPV, what is the IRR, what the decision. Okay, so you can see that payback, discount payback period, we have discussed, just follow the same logic as we discussed before. The NPV is we discussed in the first 1 or 2 questions. Should we go ahead with the project? That's the same thing, philosophy. What is the IRR, and what would be the decision under the IRR? IRR is going to compare with the discount. The company normally use the discount rate, 12%. So there are the elements here to be tested here or discussed before. So I just try to skip this one. And if you have any question, feel free to stop me at this moment. Okay, I didn't see, I just move on. Okay. Now here's a question number 2. Okay. Remember, in the very first time, I tried to bring up this question is, we all know that we should accept positive NPV project. To my understanding, very few textbooks talk about that. Even if a negative NPV project, you should consider to accept it. Here's why. There are some projects that the cash flow are delivered in such a way that you have to always pay it out. Okay? You may wonder, what kind of project that could be, and why I should invest in such projects. Think about this. You're an entrepreneur in a very popular area. You want to build a shopping mall, let's say. And when you build the shopping mall, you have to pay the cost by yourself. Not by yourself, either borrow or through a syndicated group. That's an initial investment. However, this shopping mall is going to incur the maintenance fee, electricity bill, in the rest of the life of the shopping mall. So every year, you need to pay out. And then, when you calculate NPV, not from the renting side. We're not taking the renting side into consideration. Why? Because you think about this way. Once you build this one, you are going to outsource the renting business to somebody else. So all your consideration is you need to invest in the very first beginning, and you need to pay consecutive maintenance fee in the rest of the life of this shopping mall. So you're always facing cash outflow. So in this case, you have 2 mutually exclusive projects. Which one you should choose? So you're facing both negative numbers. So tell me the logic, which one you should choose, and tell me why you choose in such a way. Follow the same logic. It's the same logic as we accept positive NPV, and suppose you only have the money to fund one project, then you have to select the project that brings up with higher NPV. Okay? So if the higher NPV is in a totally negative arena, so all the numbers are negative, what does higher mean to you? You tell me the answer, I tell you why you should choose in this way. Tell me which one you're going to choose. You have two projects. The NPV one is negative 5,000, the other one is negative 1,000. Which one you should choose? Say it again. 1,000. Why you should choose 1,000? Let's go back to the philosophy. Okay? Why you have the initial investment, say, 35 million? That's a cost outflow. It's outflow, right? If every year, and in this case, because every year you're going to expend some money for the maintenance, therefore, all the future value discounted back and sum them up has to be higher than the 35 million, right? So eventually, one becomes 5,000, the other one becomes 1,000. What does that really tell you? Is your cash outflow on this project would be 1,000 unit? It's outflow. So that's why I bring up the very first. Why the positive sign, negative sign is very important to understand this kind of question. That negative sign means that's cash outflow. As an entrepreneur, do you want to spend more money or do you want to spend less money? Yes. Everything else being equal, we have to quote this. Ceteris paribus, that's an academic word. Everything else being equal, as an entrepreneur, we want to pay as less as possible. So we're going to accept a project with, in a negative arena, with absolute value, it's smaller. And if we put a positive and a negative together, we can summarize, as an entrepreneur, we should always choose an NPV higher value. Right? So this is consistent. This is very, very consistent. It's very intuitive. Okay, so that's the flavor here. That's one flavor, but that's another one. This question brings up another issue that we have not dealt with before. I have 2 minutes. And I think I can finish this one. Is two mutually exclusive projects does not necessarily have the same length of service. One has 5 years in this one, the other has 8 years. When we calculate the NPV, it turns out to be we cannot just make the decision based on NPV in this case. Why? Because they have a different life cycle. And how do we account for that? We account for that for the equivalent annual value, which means, what does this method means is, for this kind of NPV value, what kind of equivalent annual value should be such that we can achieve 738.8977. And that's the real one to compare project with different lives. So you first need to go to the NPV first, and then you need to use equivalent annual value to compare that NPV with different project lives. And then you choose the smaller one. And in this case, this is a luxury one, and this is an econ one. Okay? So I finished right on time. for the first hour tutorial. In that class, I was told the students appreciate like a 5 to 10 minutes break, and for 2 breaks. Is that correct? Okay, we'll follow the same procedure here. So let's take
equivalent annual value always consistent with the NDD, right?
not necessarily.
Not necessarily.
In many cases, no. Because NDD has this year's see. $33, right? You said it. This one? This one? You mean this one? Yes. No, it's this one is if you don't think about the time ban, you can get back on the third year. But if you think about the time ban, the third year you're still negative. I mean, if the questions are designed in that purpose, yes, then you need to make it. Is a discounted or no discount? Is a payback? You don't need to think about discount. No, they say payback and discounted payback. Yeah, that's two different. Yes. Okay. Send me the email. Send me the email. Yes, I will. Yes, yes. But even for the consultation time, I need to get used to the calculator. I never used calculator before. I never used calculator before. Because I always use the spreadsheets. I never use the calculator. I need to get used to. I need to ask my call instructor. So this is the first time I use a calculator. We get away from this microphone.
Yeah.
We just get away from the microphone. Let me check. Oh no. This average it should be. Yeah, the average out. I think that's yes. This is the average. Average. No. Yeah. Can you use this one? Is you use either this one or use this one? It's a book. And there could also be the average this one and this one. Average book value. Yeah, it's average. Initial. Okay, then you this is Okay, let's get today's lecture. We're talking about capital budgeting 2. Let's start with an example with mutually exclusive projects with different lives. We know that we have to apply the NPV. But sometimes just using NPV is not necessary enough for us to make the correct decision, right? We can see the following example. There is a factory which must have a new air cleaner. The factory has 2 choices, the cleaner X, cleaner Y. Each has different costs, 4,000 versus 1,000, and one with different annual operating costs, 100 versus 500, and also with different life cycle. The cleaner X has a life of 10 years. The cleaner Y has a life of 5 years. So we follow what we have learned before in NPV, and we try to make the decision based on the NPV. But in this case, because the life of 2 projects is different, so if we make the decision only based on the NPV, that could be misleading. Why is that? Let's start with the cost of capital of 10%. We do the NPV's calculation. And we find out that the NPV Y, as you can see here, are always negative number. So within the 2 negative number, then you should choose the one with higher value or with the absolute value closer to 0. So in this case, you say, oh, based on the NPV calculation, I should choose the project Y or cleaner Y. But that's not necessarily correct if the life of X and Y is different. It's because the life of X lasts twice as long as the Y. So we need to use equivalent annual costs, which we have discussed in last lecture, and we did the exercise in the tutorial. Then we find out the cost, EAC cost for clean X is 750, and EAC cost for Y cleaner is 763. In this case, if we compare the 2, 750 is higher, negative 750 is higher than the negative 763. So we should choose the clean X with a longer life and with a smaller cost of expenses, in this case, based on EAC calculation. So what's the takeaway for this one? The takeaway for this is when we do the capital budgeting, just to know the present value, NPV, IRR, is not enough. You need to consider many other factors. And the life of each project is just the very first beginning we should consider. There are several other factors we should consider, and then this lecture would be devoted to what are those factors are and how do we deal with those factors when we consider the capital budgeting. So for the roadmap, we need to start with forecasting the cash flow. Then based on the cash flow forecasting, we need to consider the inflation. And we also need to consider taxation. And once we finish the consider of taxation, then we're going to show you 1 or 2 more comprehensive example. And then once we finish the comprehensive example that you're going to see today, we're going to add another element into consideration is when we're going to decide whether we should replace a project or we just should abandon that project. All these considerations are under the umbrella of capital budgeting. And that's beyond the NPV we have been familiar with. So as we can see here, capital budgeting decision can be taken in 3 steps. Forecasting project incremental free cash flow, estimating opportunity cost of capital in order to discount the cash flow, and then use the NPV to make the decision. And we already know that if we use the NPV to make a decision, let's see whether this one is going to work during the PowerPoint period. Oh, this is working. Not necessary. Okay, so when we use the NPV, we know that we should take EAC into consideration if the life is different for different projects. But today's focus would be how do we get the free cash flow? How do we get the free cash flow? To this point, the cash flows are given or assumed, but in the practice, forecasting cash flow is much more comprehensive, and it's a critical element for the budgeting, capital budgeting process. If it is mine, I apologize for that. I'm going to put it this way. So evaluating capital budgeting projects, cash flow we discounted in NPV analysis are incremental after tax. So this is the important word. First of all, has to be, have you seen this before? Yes, okay, I should avoid that. Okay, I have another way to do that. How do I get it back? Okay, so I can do this. And can I just, I don't need even a pen. Stop ink. Oh, that's much better. Okay. So I use home here. So this can let me to highlight all these things. So the cash flow NPV, okay. First of all, has to be incremental. Second, has to be after tax. And third, has to be free cash flow. So that's the 3 major elements we're going to intensively discuss today. Okay? So the free cash flow, FCF, refer to the fact that the company is free to distribute these cash flows to debt holders or shareholders. Okay, here's another question here. Let me know whether you know this. Once company has generated some cash, okay, suppose the company has the debt, outstanding debt, borrowed money from out sources. What's the first time or first place the company should distribute the cash to? Is first of all debt holder, or second of all equity holder? Debt holder. Why? Yes, it's obligations to pay the debt holders. Okay. Okay. If there are cash flow left over after the company has made necessary investment in working capital and long-term projects, accordingly, the free cash flow are what matters to the investor. Okay, a little bit further discussion on the working capital and long-term investments. Usually, it's in the investment, not necessarily in accounting, it's basically coming from accounting, but not necessarily the same thing that we are going to go that deep in accounting to talking about. If the small amount of money, the relatively small amount of money that you invest on annual basis, we would treat those as a working capital. However, if it is a large amount of money, you invest a project with a long-term perspective, then we would treat that kind of investment as long-term assets. So that's the difference between the two. So the term incremental cash flow refers to the fact that this cash flow reflects how much company's total free cash flow would change if the project has been accepted. So what does this mean? It means it's a free cash flow from the project, but it's equal to the free cash flow if we have accepted this project minus the free cash flow if we make the decision not to accept this project. And all the cash flows arising only because of with the project itself. So please note that free cash flow differs from accounting profits for a number of reasons. For example, accounts receivable and payable, which accrued, are not cash. Accrual are not cash. And we also consider depreciation and amortization, which is not really cash flows. We also consider sales and other revenues. We consider cost of sales and the expenses. In order to make that sales and other revenues, how much cost we have to pay. We have to consider depreciation, even if the depreciation by itself does not really generate any real cash flow to the company. Why we should consider this? This is because the depreciation is going to bring up benefits of so-called tax shielding. And in order to maintain our long-term profits of the corporations, we need to make investments. As we said before, the investments could be allocated or labeled as working capital or long-term investments. But let's take the working capital, for example. So if you have some free cash flow, you want to allocate a small amount of the cash flow, let's say 5% of the free cash flow, into a project you have not invested, but you plan to invest it in the next year. So this small amount of free cash flow cannot be used. Cannot be used. So it's not free anymore. Once you label this, it becomes not free cash flow anymore. It's a earmarked free cash flow. Therefore, the change in the working capital is going to have a different effect on your free cash flow. Right? Follow the logic here. If you increase the working capital here, which means you earmark more money as working capital, which is planned to use in the next year or next few years, then this capital, working capital, will out of the book that you can free distribute it. Therefore, it has increased working capital would have a negative effect on your free cash flow, and vice versa. And for the tax, of course, we're going to see that the free cash flow has a major elements coming from the calculation of tax shield. So let's get a few elements in terms of detailed calculation. Let's start with the revenue. So basically what we can see here is a shortcut to remember. $1 increase of revenue is going to lead X point dollars of cash flow depending on how much tax rate the corporation is subject to. And if we assume the corporate is subject to 30% of tax rate, then the number becomes 0.7, which means you have a $1 of extra revenue, then you can have 70 cents of cash flow. Okay, if you just judge the word I just said as is, and think about I'm the interviewee and you are the employer. You're the employer. Can you find something that I wasn't quite making it right? If you really want to poke in some loopholes in my statement. So this is the one that I want the students to understand is all you prepared here is for the future when you're on the job market. So when we say something, we have to be very careful. I missed a term, everything else being equal. Because if other things change, $1 revenue does not necessarily increase 70 cents of the revenue. For example, different tax rate. That's going to make it different. So we have to say, everything else being equal, $1 increase of revenue is going to increase the cash flow about 70 cents. Okay. The cost of expenses. Cost contribute to free cash flow negatively. Of course, this is understandable, but it's negatively with a factor of tax rate. Therefore, every $1 increase in the cost means there's a decrease in the free cash flow by the $1 times 1 minus the tax rate. So all the real cash flow are multiplied by y minus the tax rate. Now we come to the depreciation. Depreciation, that is different from the two elements we talked in past few slides, and that depreciation does not really bring up real cash flow in the past or in the past few years, either negative or positive. There's no real cash flow here. The depreciation is on the number only, okay? But those numbers are important because it provides a tax shield, and thus they are tax savings. Depreciation in this case affects free cash flow positively by reducing taxable income, which could reduce tax payable. And once the tax payable has been reduced, then there should be an increase in the free cash flow. And then our hidden assumption is everything else being equal or ceteris paribus. Then we could make the statement, every $1 increase in depreciation would be equal to an increase in the cash flow with a factor of tax rate. And if your tax rate is 30%, it's going to increase 30% of the $1 in cash flow. Okay, so far, we have talked about a few more elements that we haven't talked before. So let's put a very quick summary about how the rules are followed to generate or calculate the free cash flow in the NPV's analysis. We're including only after tax, has to be after tax, has to be incremental cash flow. Therefore, we should ignore no cash flow accounting items, not every items, no cash flow accounting items. We try to deduct or exclude allocated costs unless they reflect project-specific cash flows. We try to include any side effects, or in another academic terms in economics, we use the word externality. We try to include the opportunity costs. We try to consider and ignore that sunken cost. We exclude financing cost, and we also have to treat the inflation with a constant way. Okay, so allocated costs are charges allocated by accountants to the project to reflect its share of the firm's overhead costs. That's straightforward. Side effects refer to specific impact of the project on the cash flows of those activities. An important example on the side effect is so-called erosion. Erosion of what? Of current revenue basis. That is, the cash flow transfers to a new project from the customers or the sales of the firm's other products. What about the opportunity cost? Well, opportunity cost could arise if the project uses an asset that can generate net cash flows other places. So if we take the opportunity costs into consideration, the last NCF or the opportunity cost. What about the sunk costs? Sunk costs are those that have already been incurred. You have made the decision, you have already put up your money, but the decision to accept or reject this project is different from all the costs that you have already invested in. Cannot change the fact that you are going to make in the future, unless you are going to relabel the name of that cost. The additions of working capital, so net working capital is the difference between the current assets and the current liabilities. Most projects require additional investment in the working capital. So the investments in the working capital are to be treated in an identical manner to investments just in plants or in equipments. Additional working capital is equal to the change in the cash and the cash equivalent plus change in accounts receivable plus change in the inventories minus the change in accounts payable. So the basic idea here is anything that in the accountant marked as receivable during the capital budgeting process would be treated as to increase the free cash flow, but anything in accountants labeled as payable is going to minus your free cash flow. So this including inventories. Even if you have you increase with some new inventories, that's going to add more in the working capital. Now, here is a formal slides, okay, to address that question you may ask in the previous tutorial question here. Let's start it with the revenue. As a corporation, you generate some revenue this year, and in order to generate that revenue, you have to expand something in order to generate that revenue, and that is the cash operating expenses. So to calculate the cash flow or free cash flow, you start with revenue, and you minus the operating expenses. Now let me ask you another question here. Could revenue be negative? You don't have any income. It could be zero, but revenue could also be negative. It's in a more complicated accounting, it can be negative. Okay, otherwise we're going to see the bankruptcy of the firm. Now you have EBITDA. It's called earning before interest, tax, and depreciation, and amortization. So earning before interest, tax, depreciation, A for amortization. That's a very popular accounting item. And then here's a new thing here. Through the EBITDA, we need to minus the depreciation and the amortization. And after we minus the depreciation and amortization, we got EBIT, earning before interest and the tax. You see, still before interest and the tax. And then we use that to times 1 minus company's marginal tax rate. Now we get net operating profit after tax. Here's a question that students asked me in the other class. Is why you minus the depreciation and the amortization here, and then you need to add them back later on. Okay, let me put the question here on the table. Let me finish the rest of these slides, and I'll try to explain. Once you have net operating profit after tax, you're going to add the depreciation and amortization back, and now you have cash flow from operation. And the cash flow from operation, you need further minus capital expenditure, and you need addition minus, remember, it's a minus addition to working capital. Now, we finally arrive free cash flow. Okay, so there are two things to explain here. Why we want to minus depreciation, amortization in the very first hand, and then we need to add back again. And the second of all, you have already minus cash operating expenses. Why we need to further minus additions to working capital? So here's the logic here. Okay, let's take the relationship of the entrepreneur and the government. The relationship of entrepreneur of the government is coexistence. The government want to provide service to the society, but how the government provide service to all the society? They need money. So where did the government collect the money from? Corporation is one of them. So in this case, the government has a very incentive to set the tax rate or charge the tax as much as they could. As a corporation, you want to make profit. Therefore, the corporation has a very incentive to do not pay any tax at all. But they have to reach to a balance. When you reach to a balance, that's in our economic term, that's another academic word for that, it's called the long-term equilibrium. In the long-term equilibrium, in order for the government and the entrepreneur to coexist in an ecosystem for a long time, there is a tax rate government is going to charge the entrepreneur. Okay, right now we accept there's a tax rate, but how much to charge? The government charge say, if you make profit, I should charge you on a tax rate, based on how much profit you make. So the corporation is going to argue, in the depreciation and amortization's perspective, look, I made all these revenues, I spent the cost to make this revenue, but this revenue is not to deliver this number if I do not have my original investment in the plant, in the factory that is happened 5 years ago. And this plant is going to last 5 years, so the cost should be divided in each year. That cost is already made 5 years ago, and you should not charge me on tax. Because without that plant, I cannot make this revenue. That's why when they first calculate how much tax the government should charge based on the revenue, they should deduct the depreciation and amortization. That's the logic here. Okay? Once they deduct that, it's only for tax shielding purpose. So once they calculated that, why they need to add them back? The add them back is all these costs you deducted is just for the tax shielding purpose. If we solve the tax shielding purpose, that kind of money is you could allocate for the future use. So you should take that money for the purpose of the future. That's why you need to add the appreciation and amortization after the revenue has been considered for tax-based reasons. So that's the logic why we need to first deduct depreciation and amortization for tax purpose, and then after tax consideration, we need to add the depreciation and amortization back to the free cash flow calculation. That's the one. Okay? Now that's the other one. In the very first two lines here, we started with the revenue, we minus cash operating expenses. But in the last three lines from the bottom, especially the last two lines here, we are minus capital expenditure additions to the working capital again. Why that is? That is most likely the cash operating expenses has been happened in the past, and the capital expenditure most likely is not a part of operating expenses that has been labeled before. So that's an independent one. And usually in the real world, capital expenditure could be much larger than operation expenses. Capital expenditures usually could be much higher than the regular operation expenses. That's mostly for strategic investment projects, the much larger. Additions to the working capital follow what we have already discussed before. This is a earmarked money from the cash flow for some project that could be happened in the future. You cannot use that kind of money, and that money is also different from the cash operating expenses that you have already spent it. So that's why we need to minus additions to working capitals. And finally, we arrive the free cash flow calculation as following. It's revenue minus operation expenses minus depreciation and amortization. And that's our, this is called tax base. So this kind of money is subject to government tax. And after tax, that's after tax part. Now you need to add depreciation and amortization. Why? Because you need this money to continue your operation. Even if this is not real money, you need to take this into your calculation. And then that's the real money you probably need to spend for big projects. That's capital expenditure. And also, you may earmark some money for working capitals, which is different from operation expenses. Now you need to minus them. That's how the free cash flow. Of course, in the real different projects, different companies with different projects, this formula could be slightly changed. But this is a basic idea how we put a positive in and put a negative in is mostly based on how the cash flow is going to incur to us and whether the logic is correct. Okay? And the further comprehension to our calculation could be, say, for example, inflation. Inflation can have an impact on capital budgeting as it may affect either of the future cash flow associated with a project or the required rate of return, and in the language of NPV, that is a discount rate, or IRR, is a hurdle IRR. We have two approaches to address this one, to incorporate the effect of inflation into our free cash flow calculation. Either we could follow nominal analysis, or we could use real analysis. And the way that we're going to discuss in the next few slides to address interest and discount rate through the inflation is referred to the Fisher effects. Here's a Fisher effect, the general formula here. So 1 plus inflation. Okay, I really need this pen. Oh, I know that. 1 plus, and this number is just to show that not exactly is, let me be very careful to write this pen to see whether I can avoid that problem, is 1 times, oh, okay. Don't do it anymore, okay? So it's not worth it. So I just use this one. So this one is just it's time value of money. So you need to put the 1 unit in front in order to get the future value. So let's take this is for 1 year period. So $1 times this highlight area should equal to, and I is the nominal rate of interest rate, should be equal to, or in another language, we decompose the nominal interest rate of I into 2 parts. The first part, which is small r here, is the real rate of interest. And the second part of rho is expected inflation rate. Or simplify as I equal to r plus rho. Well, some students in the other class asking me, this one and this one, they do not agree with each other in fact. But why can't we simplify it to them? So we do everything, and we do everything for a reason. That's how I write it. If the R is quite small, so this one is, I got the question from previous class, so I modified the slides a little bit. So in this case, you might wonder to add this to your already downloaded slides. The key assumption underlying Fisher effects is the real interest rate assumed to be constant, but rearranging here is we assume that R is quite small, the rate of return is quite small, so we could approximate the times up or divide it here with the plus or minus. So that's because the number. Think about this inflation, 2%. 2%, really small. Okay? Here's the example here. Assume the current market interest rate for 1 year 6%, inflation 3%. If the inflation is expected to increase to 9% for the next year, what is the effect on nominal rates? Using Fisher effects, we determine the current rate, the current real interest rate is 2.9. So how do we get that number? That number is, we know that market interest rate right now is 6%, and we know that inflation is 3%, and we plug into the formula, we calculate that real interest rate is 2.9%. If the inflation increase from 3% to 9%, next one, we're going to show how we calculate the rate of return. Since we assume that R would remain constant over the time, we substitute 2.9 back to the Fisher effect with the rho equals to 9%. So we use the Chen rule here. This is also called the Chen rule here. It's a continuous times return. The new rate of return, expected the new nominal rate of return is equal to 1.29, which is a real investment, times the second factor, which is the Chen rule. We follow the Chen rule here, which is the 9% and inflation. And then we have to, when you after do the Chen rule, you have to minus the 1, and you get how much is the percentage change? 12%. So your real investment coming from 6% all the way to 12%. This relationship is useful for adjusting discount and hurdle rates. Hurdle rates refer to hurdle IRR rates. For inflation expected over the life for a project under evaluation. Here's another example here. Assume a real required rate of return is 10%, so the real rate of return of 10% would not change, would not change. Would not change during the life, and then what is going to change is about the inflation. So we see the initial cost here, 5,000 cash outflow. Year 1 to 3, we have a different cash inflow from 2,002 to 3,000, and we have a different inflation rate. So the solution here is we could use a nominal analysis or we could use a real analysis. As I want to point out here is a nominal analysis. The real analysis deliver the same result, 621. However, the second element is they are calculating formula mechanically are exactly the same. But their economic meaning here is quite different. So let's see what's the similarity, what's the difference here. If we follow the nominal analysis, cash flow would not change. It's the cash flow. Because why? Because the nominal analysis, that's a real cash flow happened in the future. However, the discount rate will change. Why? Because the discount rate here, we'll follow the chain rule. Use the real rate of return, and then the second element is we need to take the inflation in every year into consideration. First year, 5%. Second year, 7%. However, in order to get the 7% inflation in the second year, you have already experienced 5% inflation in the first year. Therefore, for the chain rule, we need to take real rate of return here for 2 years. So that's 1.1 to the power of 2 times the inflation in the first year, 1.05. And then times again the inflation for the second year. So that's how we get this. So you see, by the nominal analysis, the cash flow has no adjustment. We just adjustment the discount rate based on the different inflation. But for the real analysis, even if you look at the formula here, tell me these elements. Is that the real difference of these elements which I highlight here in the real analysis compared to its counterpart in the nominal analysis, which is on the upper? There is no. Mathematically. But the economic meaning is different. Why is different? Let's see here. In the numerator, let's only focus on the numerator that I highlighted here. 3,000 cash flow and divided by 1.05 times 1.07. What does that mean? Okay, this is the other thing I want to, I always tell my students before, but I'm keep telling, is eventually you're going to on the job market. Okay? During the interviews, one of the interviews, of course you're going to do the calculation, you sit in the exam room, do the calculation, that's a different story. But there are interviews you have to deal with potential employees. During the interviews, people ask you the questions. You need to have this capability to turn the mathematics into the language. You need to describe what has been written in the mathematics and speak out in the English. That's a communication. And for this one, you think about this. How do you communicate this? You cannot say, come here, let me write the formula. I show you what the really answer to that question. Of course, you can do that. But if you can talk about this in a layman English, that's going to make you more attractive to the employer. Okay, tell me what's this one. 3,000 divided by 1.05 times 1.07. What does that really mean in English?
It's your present value adjusted for inflation.
It's present value. Okay, you can take something like this. Oh, very short answer is present value, 3,000 in the second year adjusted for the inflation. How do I adjust the inflation? Because the first year inflation is 5%, the second year's inflation is 7%. In order to just discount the present value of 3,000 in year 2 back to the year 1, I need to use the chain rule to times 1.05 to 1.07, then I can get the present value. So that's the basic language. It's the basic meaning of the way we use the mathematical terms. Of course, when you sit in the classroom, you need to convert this kind of skill into the mathematical calculation. So you need both skills, going A to B and to B to A. Okay? So you can see that this is different. Okay, second question. After you discount the 3,000 by the inflation, right now, the 3,000, which I highlighted here, is what value? Is what value? Still nominal? Because the real, yes. Right now is 3,000 discounted by or just by the inflation rate. But is that present value or is that future value? It's future value in what terms? Real rate of return terms, right? This is for real rate. So what you further need to do is, in order to eventually calculating that 3,000, its present value at year equal to 0, you still need to discount the no inflation 3,000 in year 2 back to year 0, which you need to use a real rate of return, which is 1.1. So if you can say something like this, people know that you fully understand what is meaning. Okay, so we keep moving on. As we can see here, it's accepted. Okay, so there are several things we talk about a tax. Now, it's time to address how do we actually calculating those taxes in the capital budget. It's a relatively good time we stop here because once I started with tax, there are several pages that I want to go through without interruption. So let's stop here and we take 5 to 10 minutes break and we come back to keep on our discussion. Okay, let's get started. Okay. So we're still in the tax and capital budgeting. If there's no more tax, therefore, there are relatively few items we should consider. But among those items, we still need to consider the timing and the magnitude of the cash flow. And sometimes different timing, they could affect the magnitude of the cash flow, which make the decision to accept or reject a project become vulnerable. We also need to determine the appropriate of the discount rate, and also, as we know that the change of the discount rate could also change the decision whether we should accept the project or not. However, if we add tax back, the tax has, of course, an effect on both those estimates. And that tax is going to affect both the numerator and the denominator. So what we should do is we try to apply or follow the same principle consistently. So first, we should look at the impact of tax on cash flows, which is on the numerator. And having already evaluated the impact on the K, and then we need to think about the different tax system. So in order to take the taxation into the consideration in a very general and broad perspective, we need to consider three elements. Of course, in the real world, in the real projects, you could expand that three elements to 5 or more than 5, but what we have put in here is the three elements is what you should consider in even a very simple real world example. First of all, we have to consider what is the income, tax on the income. And the second of all, we have to consider how much is the tax shield. And the third, in most of the investment in the corporate budgeting, we have to consider tax on the capital gain. And also, if you have the gain, of course, you may suffer, the company may suffer capital loss. And if you have the capital loss, then the tax becomes a benefit for the loss. Of course, it's very hard to say the tax is going to benefit based on how much loss you have, but anyway, it's going to reduce the tax payable. If the government put the tax on the income, that represents a cash outflow for the entrepreneur. However, the tax shield would bring the benefit to the entrepreneur by providing a tax reduction or deduction. And how much we can get from that? That's based on the calculation from the depreciation. And the tax shield on the depreciation depends on how much depreciation you want to put in that number, and then how much tax rate the corporation is subject to. The result is based on the product of the two items. And for many companies, they could have sales of an asset during their regular operating. And if the sales of an asset, of course, most of the case, sales of assets would generate a positive value, then you have to pay tax on that. It's after-tax cash flow from sales of an assets. And how do we calculate that? Is we started with salvage value, and then we use the salvage value minus the book value. So salvage value minus book value is sort of the end value. And then the difference between the salvage value and the end book value is equal to the after-tax base for the cash flow from sales of an assets. If I put everything times the tax rate here, and if you put everything sorted out in the mathematically, we have the capital gain tax is equal to salvage value minus the book value and the result times the tax rate. As you can see here, if the salvage value is less than the book value, the capital gain tax would become negative. The income tax is assessed on the taxable income of the taxpayers, which including companies under the management of Income Tax Assessment Act 1936, 1997. According to the, therefore, net cash flows are often stated on the after-tax basis, which is in the format of net cash flow, which is tax base, times the result of 1 minus the corporate tax rate. However, when we do the calculation, there's one item that has been missed in this expression, is that the timing, how do we tax the taxable income? So the timing of a taxable income does not really correspond with why there's a difference here. It's because that the income you received or marked in your annual report, and the corporate annual report in the United States is called a 10K. Does not necessarily be equal the same time as the entrepreneur received those monies. What is recorded in the annual report does not going to be the same time as the entrepreneur to receive those monies. And usually they're different. If that's the case, then does create a problem. So therefore, there is a lag before the payment of the tax. Therefore, there are some leeways for the accountant to apply for. Are you going to charge the tax rate before or charge the tax rate after? And let's see, there is an example of that. Also, the above expressions ignores the effect of tax deductibility of the expenses that do not involve a cash flow. Like we said, it's a depreciation. Losses on the asset sale. No cash expenses provide a tax shield since they reduce taxable income. Why we want to say this? It's the same argument that we have put forward to argue with the government. Just because I record this amount of revenue off the operating income is because you cannot charge the full amount tax rate on those off operating income. Why? It's because those money is coming from my original investment, which is going to last for quite several years. I need to deduct them year by year. Why I want to do that? Because I'm an entrepreneur. I want to keep going, my business going on. Those investments eventually need to be replaced by new investment. I need to collect those money back. So that's the argument for the entrepreneur to use no cash expenses, provide a tax shield, and use that tax shield to reduce how much tax the entrepreneur should pay for the government. In project evaluation, we need to incorporate the value of this tax shield, and the tax shield, as we discussed before, would equal to the depreciation times how much the tax rate would be. Thus, the company is subject for. Okay, here there is another new element here. How do we dispose of or an asset that has been originally discounted for the full service of full service years? Or is that the salvage value that when we dispose those assets in the markets, and how we treat in the cash flow calculation, in the free cash flow calculation? So these are the simple rules we have to follow. When a depreciated assets is disposed of, the proceeds received are the disposal or salvage value. Typically, there will be a gain, either a gain or could subject a loss on the disposal for both accounting and tax purpose. Technically, they could be different amounts. This is a disposal value less the asset's written down value. What is a written down value? That's a net of depreciation charge. This amount could be either gain or loss, and the disposable has a tax effect because it's going to be assessable income. It could bring you some cash in, or they could suffer some loss, which is unaccount. Therefore, you could be charged on tax if it's positive, and if it's a negative on the number, then you can provide some tax benefit on this. For tax basis depreciation, for tax purposes, there are alternative concepts to calculate the depreciation deduction. Basically, we have followed the accountant with two methods. The first method, I would like to say it's a straight line or prime costs. The second one is diminishing value, which is a reducing balance. Basic idea here is explained in the next slides here. Suppose you have an initial investment. It's 1,000. And suppose this investment or this asset has a value, a service life of 5 years. And after 5 years, the value of these assets becomes 0. So that's how you say zero scrap value. So there are two ways to depreciation this 1,000 in 5 years. Either you could use the method 1, which is the straight line depreciation, $1,000, 5-year service, each year is 200 divided by 1,000 by 5. So every year deduct 200, and in the last year equal to 0. Or you could use diminishing value. The diminishing value is you start from the original investor of $1,000, and 33% would equal to, of $1,000 would equal to 330. And you minus that 330, you get the book value in the beginning of the second year equal to 670. And then use the 670 depreciate times 33% again, that equal to $221.10. And you minus that one from 670, you get the beginning book value on the third year as 448.96. You keep doing this way until the end of the 5th year, your end of the book value is 0. That's two different methods. So to further analyze this example, let's take the ABC company considering to purchase a new 100,000 machine which has the following specifications. The company, subject to rate of return, think about this 10% as a cost of capital. Think about this, the entrepreneur, they always don't have enough money to invest. That's why they should have a cost of capital, because they need to go to the market to borrow debt. Think about this rate of return is the interest rate this entrepreneur has to pay in order to borrow the money from the debt markets. And if the investment has been established with 100,000, this investment could generate incremental annual cash flow. This is inflow, should be understood in this way. 32,000 each year. This machine has a life of service of 4 years and could be fully depreciated for tax purpose. And after 4 years, there is a salvage value for this machine by the company. They could sell the company in the market for 10,000. Cash flow occurred only in the end of each year, and corporate tax would be 30%. So what about the cash flow we should calculate? Well, the first line here, if you look at, the first column here, if you look at the project screen here, this is just the raw numbers. At year 0, there's a negative 100,000, which means the 100,000 cash outflow in the perspective of the entrepreneur. And since the year 1 and year 4, there is a cash inflow, so that's why there's a positive 32,000 in each year. But next one, we have to be careful about this, is how do we calculate, first of all, how do we calculate how much tax we should pay? And second of all, how do we put when this tax has to be paid? Okay, think about the previous slides here. Cash flow occurs at year end, okay? And the tax rate is 30%. Okay, let's go to the next one. Think about in the end of the first year, you'll get 32,000. And 32,000, that's your income, right? In order to calculate the tax shield, you need to consider depreciation. If we use straight line depreciation, original investment 100,000 divided by 4 years, therefore each year your depreciation for tax basis, for tax shield purpose is 2,500. 32,000 minus 2,500, and then how much tax rate do you have to pay? That's your tax base. This amount is your tax base. Tax base times the tax rate, this is the money of the tax you own government. The entrepreneur owns the government. But it doesn't say when the government is going to charge this money. So you have the 2,100, and you can put either here in the year 1 or next in the year 2. There's some leeway you can play. You negotiate with the government, you say, because my cash flow only comes the end of the year, you need to give me 1 year to pay out those cash. Usually I earn the money in the beginning of the year, you charge the money in the end of the year. That's reasonable. Government say, okay, I give that. Therefore, in the beginning, even if you have a cash inflow in the end of the first year, there is 32,000 come in, you could negotiate that the tax will not be paid for 1 year period. The tax will be paid for in the end of the second year. That's normal. You need to give me, I earn this money, and it cannot be charged at this moment. Okay, so that's how we calculate. So once you do the calculation, this taxable payable, then the present value at 10%, this one, is you just discount $1 by the cost of capital, which is 10%. How much is the present value of the $1 at end of each year? Then the present value eventually is going to, you started with the present value 100,000, then you use this amount, look at my mouse cursor here, times this amount, you get, and then you sum all these calculations up, you got present NPV 351. Because the NPV is positive, that's the only project you have, you decide to accept it. Okay? But let's change. Suppose the government doesn't agree with that. That's also possible. Government say, no, I want to charge the tax in the same time that you incurred the profits. In this case, the 2,100 of the first year tax would be charged in the same year that you report this income, even if you have not received the money yet. Okay? And in this case, all the calculation follow the same procedure as we discussed in the previous slide. The only difference is government is going to charge your tax when you report in the annual report, and during this time, that the money has not come into your account yet. But in this case, you'll find out the NPV project becomes a negative 439, and in this case, as a rational investor, you should not take this project because it's a negative NPV project. So far, you can see that things are quite comprehensive in terms of free cash flow calculation. But we don't want to stop here. We want to push your understanding to a higher level. In order to do that, we show you a possible, it's okay, it's not that complicated. It's an okay problem that probably you are going to deal with in the future once you got a job. It's not that comprehensive, and we're not asking you to get all the answers based on the information we give here, but we just want to show you in the next 3 slides how complicated the free cash flow calculation could be to some extent, not extreme case. Next 3 slides, bear with me as I read through. Okay, next 3 slides. There's a company called XYZ. You can nuts and bolts, it's a make up the name. Is assembling business run by a solo proprietor whose marginal tax rate is 47%. The owner is considering purchasing a new fully automated machine to replace an older manually operated one. The machine being replaced now has a 5 years history of service, originally had expected life of 10 years. This is very important, okay? Has original life expenses in 10 years, right now has already served by 5 years, and the owner consider whether they should replace this machine, and once it's replaced, the machine could be either, old machine could either be discarded or could be sold in the markets. The old machine cost $20,000, was being depreciated over its useful life using straight line method. And it's 10 years. So every year, straight line method would give a depreciation of $2,000. And if the machine is to be sold in the market after 5 years, right now after 5 years, then its market value is $15,000. The old machine was operated by one operator who earned $15,000 in salary and $2,000 in fringe benefits each year. And if the machine has to be replaced, then this operator will not be necessary, so they could save some money. The annual cost of maintenance and defects associated with the old machine were $7,000 for the maintenance, $3,000 for the defects. So in total, $10,000. It's just the first slides. We'll come to the second. The replacement machine, the fully automatic new machine, being considered, has a purchase price of $50,000 and expect the salvage value after the 5 years of life is about $10,000 in the market and would be fully depreciated over the 5 years using the straight line depreciation method. To get the automatic machine in running order, the entrepreneur has to pay $3,000 for shipping fee and another $2,000 for installation fee. Therefore, in order to run the machine, the entrepreneur has to pay $50,000 with a purchase price plus $5,000 for the shipping and installation charge. So in total, $55,000. And has a value, has a life of 5 years, and has a salvage value, expected salvage value in the market after 5 years for $10,000. To get this automatic machine in running order, or in addition, because the new machine would work faster than the old one. Therefore, the entrepreneur need additional investment in raw material and goods in progress, including the inventories, which would need to be increased a total value of 5,000. So you can think about this is 5,000, this cost is going to be occur on annual basis. Okay, annual basis. So this one is like what we discussed is increase of the working capital in our discussion before. And the annual cost of maintenance is about 2,000, and the defects for the new machine, 4,000. So in total, annual cost for maintenance and defects would be 6,000 in total. Okay. So far, all the information, most of the information we're going to use, but the rest of the information, we're not going to use most of them, but we want to show you how complicated this question could be. The new machine also requires maintenance workers to be specially trained. Fortunately, a similar machine was purchased 3 months ago, and at that time, the workers completed with a 5,000 training program need to be familiarize themselves with all the new equipments, and the knowledge is transferable. The company's management is not sure whether to charge the half of 5,000 training fee to the project, or the other way is could put it into the depreciation. They could order. We are not going to ask you to deal with this one in the question, but I just show you there are many things they could consider. Finally, to purchase the new machine, it appears that the company would have to borrow an additional 20,000, which is coming from the market, and has to pay that interest rate 10% from the local bank, resulting in an additional investment payment of 2,000 per year, which is the interest rate, and also the company need a hurdle rate of return, which is the required rate of return on any projects that has to be over of 20%. Given this kind of information span over 3 slides, now there is the question we want that you or us to solve. What are the project's free cash flows? And given those cash flows, what is the NPV? What is the internal rate of return? Based on either NPV or internal rate of return, should we arrive the conclusion whether this project should be accepted or abandoned, and why we should do so. So by the way, one student asked the question is when we ask, because the calculation of the NPV and IRR, sometimes they are correlated. And the questions, they could have different answers in terms of number, if you use NPV and if you use IRR. However, the two approaches should support with each other to the end by making the decision. What the decision is if you calculate from the NPV's perspective, then the higher NPV project should be selected. If you calculate from the perspective of internal rate of return, then the project could be considered to accept as long as the IRR, question here, A, higher than the cost of capital, B, lower than the cost of capital, should be accepted or reject? Should be accepted. Which? Higher, yes. So they should be arrive with the same. Okay, let's talk about free cash flow first. We started with time equal to 0. Time equal to 0, there is no cash inflow, is it? Not necessary. Okay? We're going to see there are some cash inflows. Okay? So that's why we need to go through the information piece by piece. The new unit, how much is going to cost the entrepreneur? 50,000 for purchase price, 3,000 shipping fee, and 2,000 installation fee. So in total, the entrepreneur has to pay 55,000 in order to make that purchase and make that machine up to running. Since the entrepreneur has made the decision to purchase the new automatic machine, the entrepreneur said he or she wants to sell the old units. The old units sold in the market could generate 15,000 salvage value. Okay, salvage value. If you treat this salvage value as all the income you have, government is going to charge the tax rate on this amount. That's not fair. So you argue with the government and say, look, that salvage value comes with a book value of 10,000. Okay, that's my argument. So right now, you are my accountant. Government is going to challenge me. Government will say, why is 10,000? I think it's 2,000. So you need to argue with the government. How do you argue government? You are my accountant right now. I'm the entrepreneur. Government charge me money, and I make a very bold statement. I said, the book value that going to lead to the, of course, according to that, that's agreement between government and me. I have salvage value, I should minus the book value, and that's our tax basis. So the point here is there is a difference understanding on how much the book value I should put here. I say 10,000, government say 2,000. Which one is correct? You are the accountant. You help me. Go back to check the information in the first slides. And try to, you're the accountant, try to find either you are going to support me or you're going to hammer me. Okay? Tell me. Government say 2,000. I say 10,000. Which one is correct? The book value. Why? Why that's the case? So that one is going to help you to further hammer the idea of depreciation, how much depreciation each year, and once you depreciate for a certain amount, what's the leftover? Remember, 20,000 for the cost of an old machine. The machine has a life of 10 years. How many years? Use the straight line depreciation. So each year is going to depreciate for 2,000. How many years has been depreciated? 5 years. How many years are left over? Another 5 years. Each year is 2,000, 5 years. Therefore, you put that argument, the government has nothing to say. It has to accept my statement. 10,000. Therefore, originally government really want to charge me on tax based on 15,000 I made. But right now, government has to accept that he's only going to charge me on the old machine's perspective 5,000. And this is the tax I saved for my company. Okay, that's one. Once you get 51 paying cost or paid out cost, you got this aggregate is income 5,000. As you can see here, actually you get income 15,000. But to argue with the government, there's only 5,000 on the book. That's illegal. Now you have 50,000 in the summary. And that's going to, but remember, that's a negative number. That's a negative number because you paid that money out. Okay? Then 48% of tax rate is coming from the 50 times the 47. So that's a less tax. And because you also need 5,000 to increase the inventory, you remember every year because the new machine runs faster, you need 5,000 annual basis to keep more inventory and small working capital. So you need put the 5,000 here. Therefore, everything else that's been summed up is equal to 47,350. And that's your first year, or in the beginning of the first year, the cash flow, and after cash flow, considering the tax basis, that's your so-called free cash flow. It's a negative number. Of course, you spend the money to purchase. Now is the time to do the second year all the way to the end of the 5th year. Now, that's first year. As you can see here, let's take a look here. If I look at the year 1-4 column and year 1-5, and you compare the number column by column, they're actually the same. But why we still put it into a different column? Because in year 5, there are 3 additional items here. Therefore, we decided to put 1 year to 4 in a different column, and we can start it from 1 by 1. Since 1 year and 4 and year 5 are the same in this slide, so we're going to discuss only this one item by item here. In the incremental revenue, which is the new minus old, that's 0. It hasn't any revenue yet, right? But you have some other, either cash flow or savings. For this one, how much salary you have saved as an entrepreneur? Well, originally the old machine requires an operator whose salary is 15,000 per year and 2,000 fringe benefits. In total, you don't need that operator. You can save 17,000. That's your. And also incremental saving is originally the old machine require 6,000 maintenance, 4,000 for defects. You need to spend 10,000. But for the new machine, you only need to spend 4,000 for maintenance, 2,000 for defects. So your saving is 10,000 minus 4,000. That's minus 6,000. That's 4,000. Okay, here's the depreciation. Depreciation becomes slightly complicated, but we have to get used to this. You understand the first one for the new, then you can understand the following, the same logic and the old one. So how we get the depreciation is new, and this number use minus 11,000. Okay, my question is coming on 2 dimensions. How do I get 11,000 in the number first, and the second, why I should put the minus here? 30 seconds to think. How I get 11,000 depreciation for the new? Okay, 50,000 for purchase the machine, 5,000 including 3,000 shipping fee, 2,000 installation, 55,000. What's the life of the machine? 5 years. What's the depreciation method I use? Straight line. Therefore, each year is 11,000. That's understandable, right? And follow what we have discussed before. This amount of money should deduct the revenue that I have already generated, because otherwise the government will charge me more money, more tax. That's why I need to put a negative sign on this one, right? Okay, understand this is really critical to understand the next item. And depreciation of the old machine becomes positive. Why it becomes positive? First of all, how do I come up with a 2,000? Second of all, why this is positive? Follow the similar logic, right? The 2,000 coming from 20,000 machine, 10 years of life. Each year, depreciation is 2,000. But next one is why I change the negative sign into a positive sign. Because in this case, of course, you really want to minus as much as you could. You try to manipulate with the government and say, I want to put a negative sign in front of the 2000. Government say, no, that's not correct. Why? Because it has originally depreciated for 10 years. Right now, it depreciates only 5 years, and you sold the machine. There is a 2,000 each year that you should depreciation by keeping the machine, but you didn't do that. Therefore, as unfair purpose, you need to add them back. You need to be charged on tax on those money. So you see here, this is critical to this 2000 thing. Once you put everything together, that's our point, start point to calculate the EBIT, earning before interest and tax. That's a summary. Once you calculate the summary EBIT, you times the tax rate, which is 47%, you get the number 5,640, and because that's taxable, that's a tax amount, so you need to put a negative sign in that, and then earning after tax, it's 6,360, and don't forget to add the depreciation back for the free cash flow calculation. So what's the net effect? Your depreciation minus the depreciation, 11,000, your plus the 2,000 depreciation you should incur in the next 1 to 4 years, but you didn't do that. Therefore, the net effect is depreciation is negative 9,000. You should add them back. That's calculate the operating cash flow from year 1 to year 4, and this element will not change even in year 5. But in year 5, there are some additional elements here. That's in the next slides. Remember, this machine, after 5 years, even if fully depreciated, the entrepreneur expected could sell this machine on the market with a 10,000. So that's the salvage value. Therefore, the salvage value sell the assets, you generate income that is subject to government tax. That's exactly 47%. And also because you sell that machine in the market, so you don't need that annual incurred cost for increased inventory and other working capital. So you're going to save 5,000. That's a recovery of new working capital. Therefore, you put all the number. This is coming from the previous year, previous slides. You put the previous slides, 15,360 together. The final year cash flow is 25,660. Okay? I spent quite a lot of time to go through the cash flow, but the rest of the calculation is more routine. So let's get to this. So based on this, you use NPV, you use IRR. As we said before, NPV, IRR, of course, is going to generate a different number, but they're going to provide a consistent conclusion. NPV is positive, IRR higher than the cost of capital, so you should accept this project. Okay, so I have a few minutes. Actually, I have 1 minute over. Okay, so I want to say here is there are some things here. Let me point out a few. When we consider all these capital budgeting things, we still need to consider equivalent annual value method. And that one is going to explain in the next few slides. You can see that because you follow all the logic we have discussed in the classroom. You should have no problem at all to get all this correct. And that's pretty much what we try to elaborate in the classroom. Okay? Yeah, that's pretty much I want to say. Any questions? As I said before, I'm going to stay here. I can either step outside of the classroom for the next hour. Should you have any questions, please feel free to come to me. Thank you. That's today. Oh, yeah. So let's talk about that.